Welcome to Gap City, Population Profits. Hey everybody, welcome to the show. Today we're diving headfirst into the exciting world of gap patterns and technical analysis. These babies are like flashing neon signs on Wall Street, screaming buy, sell, buy, sell. Okay, maybe not that loud, but you get the picture. Today, we'll explore the different types of gap patterns, what they signify and how traders interpret them. Because let me tell you something, folks. Understanding these patterns can be the difference between booking a one-way ticket to Profitville and, well, let's just say you don't want to end up in the other place. So, buckle up, get ready for a wild ride, and let's unlock the secrets of gap patterns together. Booyah! Alright, let's kick things off with the most frequent flyer in the gap world, the common gap. These little guys are like those pesky fruit flies buzzing around your kitchen, annoying but ultimately harmless. You'll see them popping up in sideways, range-bound markets, those snooze fests where the stock is just bouncing around like a ping pong ball. They're usually pretty small and come with low volume, which basically means the big institutions, the smart money, aren't interested. Think of it like this. If a stock gaps up on low volume, it's like a party with no music. It's just not going to be that exciting. These gaps often get filled quickly, meaning the price usually retraces back to where it was before the gap. So, don't get too trigger-happy with these common gaps. Remember, we're not looking for pennies, we're looking for serious gains. And these common gaps, they're just not going to cut it. We're after the big kahuna, the kind of gaps that make your portfolio sing. So let's move on to the more exciting stuff, shall we? Now we're talking. Breakaway gaps, my friends, these are the real deal. These are the gaps that get me fired up, the kind that make me want to ring the opening bell at the NYSE. Imagine a rocket ship, fueled up and ready to blast off into outer space. That's what a breakaway gap is like. It happens at the end of a consolidation phase where the stock has been stuck in a tight range, like a coiled spring ready to unleash its energy. You'll often see these gaps forming after a chart pattern like a symmetrical triangle or a rectangle. And when they break out, bam! They explode with high volume, signaling that the big boys are piling in, and a new trend is about to take flight. Breakaway gaps can be either bullish or bearish, depending on the direction of the breakout. If it gaps up, look out above. It's a sign that the bulls are in control and the stock is ready to soar. But if it gaps down, watch out below. The bears are in charge and the stock could be headed for a tumble. The key here is volume. Remember, volume is our confirmation. It's like the roar of the rocket engine. The louder it is, the more powerful the thrust. So, when you see a breakaway gap with high volume, jump on board and get ready for the ride of your life. Alright, now that we've got the breakaway gap under our belts, let's talk about another powerful gap pattern, the runaway gap. These gaps are like adding fuel to an already raging fire. They occur during a strong, established trend, and they confirm that the trend is still in full force. Think of it like this. You're surfing, you've caught a monster wave, and you're riding it all the way to shore. That's what trading a runaway gap is like. You're riding the momentum, baby. Runaway gaps typically have moderate to high volume, showing that there's still plenty of interest in the stock, and they can give you valuable clues about how much further the trend might run. Now, here's a little trick of the trade. Look for runaway gaps to occur roughly in the middle of the price move. That's where they tend to be the most reliable. But remember, even the strongest trends eventually run out of steam. So, don't get greedy. Keep an eye out for signs of weakness, like decreasing volume or bearish candlestick patterns. When the music stops, it's time to cash in your chips and head for the exit. Alright folks, it's time to talk about the last gap pattern on our list, the exhaustion gap. This one's a bit of a party pooper, but trust me, it's crucial to recognize it. You know that feeling when you've been partying all night and you're completely spent? That's what an exhaustion gap is like for a stock. It happens at the end of a trend, when everyone and their grandmother has already bought in, and there's no one left to push the price higher. These gaps are usually characterized by very high volume, often driven by emotional retail investors who are late to the party. But here's the thing, when everyone's already in, there's nowhere left to go but down. Exhaustion gaps are a warning sign that the trend is about to reverse, and it's time to take your profits and run for the hills. Now here's how to tell if a gap is the real deal or just a fake out. Look for a bearish candlestick pattern, like a shooting star or a bearish engulfing pattern, forming after the gap. That's a clear sign that the sellers are in control, and the party's over. Remember folks, greed is a dangerous emotion in the market. Don't be the last one holding the bag when the music stops. There you have it, folks. The ins and outs of gap patterns in technical analysis. Understanding these patterns can significantly enhance your trading strategy, helping you identify potential breakouts, ride momentum, and avoid getting caught in reversals. But remember, volume is key to confirming the strength of a gap. High volume means conviction, while low volume is a sign that the move might not be sustainable. So, always pay attention to the volume. Thanks for watching, and happy trading. Remember, in the market, knowledge is power. Now go out there and make some money.